One vacant unit in a 10-unit building is a 10% vacancy rate. One vacant unit in a single-family rental is a 100% vacancy rate. That single distinction explains why experienced investors migrate from single-family to multifamily as they scale. The income resilience of multifamily, the protection against any single vacancy destroying your cash flow, is structurally different from single-family investing. In this video, I'm going to walk you through multifamily investing from the beginning. What it is, how it's valued, why it matters, and how to get started. My name is Rick Puglisi. 19 years, 400 plus transactions. Let's get into it. Small versus large multifamily. Multifamily falls into two distinct categories. Small multifamily, 2 to 4 units, financed like a single-family homes, using conventional or FHA residential loans, including the owner-occupied FHA option. Valued using comparable sales like single-family. Accessible to beginning investors with conventional credit and modest capital. Large multifamily, 5 or more units, financed as commercial real estate through commercial loans, valued based on income, specifically net operating income relative to market cap rates. It requires more capital, more experience, and more sophisticated analysis. The path typically starts with small multifamily and scales towards large multifamily as capital, knowledge, and track record develop. How multifamily is valued. This is the most important concept in multifamily investing and the one that creates the most powerful opportunity for sophisticated investors. Single-family homes are valued by comparison. What did similar homes sell for nearby? Commercial multifamily is valued by income. Net operating income divided by the market cap rate equals property value. Net operating income is the property's annual income minus all operating expenses, excluding the debt service. If a 10-unit building generates $150,000 in annual rent and has $60,000 in operating expenses, the NOI is $90,000. Cap rate is the market's required rate of return on that type of property. If the market cap rate is 6%, the property is worth NOI divided by the cap rate. 90,000 divided by 0.06 equals $1.5 million. Why does this matter? Because you can force appreciation by increasing NOI. Raise rents by $50 per unit on a 10-unit building, that's $6,000 in additional annual NOI. At a 6% cap rate, that additional NOI adds $100,000 to the property value. You forced $100,000 in appreciation by raising rents $50 per unit. The advantages of multifamily. Income resilience. Multiple units mean no single vacancy destroys cash flow. Economies of scale. One roof, one insurance policy, one property manager for multiple units. The per unit cost of ownership is lower than single family. Financing efficiency. One closing, one set of legal fees. One appraisal funds multiple income-producing units. Professional management accessibility. The revenue supports professional management economically in ways that single-family often cannot. Getting started. The most accessible entry point for a beginning investor is a 2 to 4 unit property financed with an owner-occupied FHA loan as little as 3.5% down. Buy a duplex or fourplex. Live in one unit, rent the others. The rental income from the other units offsets or covers your mortgage entirely. You build equity, generate income, and gain management experience with the lowest financing barrier in real estate. Let me tell you about a deal that changed the trajectory of my investing career. I purchased a quadruplex, a 4-unit building, from a bankruptcy trustee in Orlando, Florida, for $2,000. The property was fully rented across all 4 units, generating close to $5,000 a month in total income. Because I had educated myself on foreclosure law and the defects in the closing documents, I was able to hold that property, collect the rent, and litigate the foreclosure for 24 months. The case ultimately resolved with a significant settlement. Total profit from that $2,000 purchase, $130,000. That was a multifamily deal, and it taught me something I have never forgotten. The right multifamily deal, analyzed correctly and executed properly, produces incomes that single-family investing simply cannot match. The skill is in knowing where to look and how to analyze what you find. Key metrics. 4 metrics every multifamily investor needs to understand. Cap rate, the NOI divided by the purchase price, tells you the unlevered return on the asset, compared to market cap rates for similar properties to assess whether the price is fair. Cash on cash return, annual pre-tax cash flow divided by total cash invested, measures return on your actual capital deployed, including the effect of leverage. Gross rent multiplier, purchase price divided by annual gross rent. A quick first filter. Lower is generally better. Debt service coverage ratio, NOI divided by annual debt service. Most commercial lenders require 1.25 or above, meaning the property generates 125% more income than needed to service the debt. Below 1 means the property does not cover its own mortgage. Multifamily investing is not more complicated than single family. It is differently complicated, and the rewards, income resilience, forced appreciation, economies of scale are structurally superior for investors who are serious about building a portfolio. The path starts with a duplex or a fourplex. Owner-occupied, FHA financing, 3.5% down. From there, the math scales. Multifamily investing is covered in Module 7 of the Mastering Real Estate Investing program. Start with the free 5-day challenge and click the link in the description. 0 cost. My digital clone handles the videos. The real me handles the deals. We have a good system. Hit subscribe for weekly content. Drop a comment. Are you considering multifamily? And what is your biggest question about getting started? I read every comment. I'm Rick Puglisi. The quadruplex that changed my career started with a $2,000 purchase. What's yours going to start with?